Hey guys, Ben Nash from Pivot Wealth, and today I'm bringing you money news in human words, talking about the tech market slump, the disruption that we're seeing to the property market, some new crypto ETFs that are launching, and a bunch of interesting stuff that's been happening this week, helping you understand the key things that you need to know to take advantage of the opportunities that are out there and avoid some of the mistakes and issues that might hold you back. Before I get into the news, though, I just wanted to unpack the share market numbers for the week. So share market was really interesting last week. We saw the interesting slash painful. We saw the markets pumped off the back of some of the inflation data that was coming up. Friday, the NASDAQ ended up down over 4%. That's a huge slide in one-day terms. And yeah, we're up there with some of the biggest losses that we've seen. And sort of quite variable throughout the week as well. Some days down 3%, some days up 3%. So pretty wild. Overall, the Aussie share market ended up 2.5% lower than last week. The S&P 500, so the 500 largest companies in America, finished the week down 2.18%. NASDAQ down 2.19%. And the Global All World Index ended up just down 1.74%. Crypto Mega Cap Index down 11.6% for the back end of the month to date. Our investment story of the week is NetCentric. They're a social media influence marketing company globally. They got big markets across Asia and live campaigns there. They basically had a kick up of 20% on Thursday rather, as a result of some release of earnings data at the back end of the week, and one that's definitely to watch over the next little while. So, looking at the news, look, one piece of news that caught my eye last week was around investors with cash at the bank losing money in real terms. And I think this is a really, really big issue. We're seeing, inflation's running at 5%. We've got cash at the bank is earning you less than 1%, which means that your money's actually going backwards by 4% a year, which is a pretty significant slide in purchasing power terms. And when you think about the fact that investments are increasing in value at the same time, it means that you're really chasing your tail. So what that means for the end result is slower progress for investors. And sometimes that frustration or fear or FOMO, the psychology side of things, can push you to make bad investment choices, and then you end up losing even more money. The really big frustration, though, is that when you don't know, you want to invest but don't know what to do. You've worked hard to save up this cash, so you don't want to end up doing something silly that's going to cost you a bunch of money, and then you end up stalled in the inaction trap, and then more time passes and you're actually further away. Also, this is particularly relevant for would-be property buyers, which is where you see people building up big deposits. They're sitting on the sidelines, and that opportunity that can be costing you in terms of opportunities. But really, the way I see it, the opportunity is for investors that you make smart choices and get your money actually working hard and growing for you. So the actions there to put this to work, I suppose, is to educate yourself, really understanding that everything has their pros and cons. Every investment option has risk attached to it. Buying shares has risk attached to it. Buying property has risk attached to it. Buying crypto has risk attached to it. Doing nothing has risk attached to it as well. So understand those risks and trade-offs so that you can figure out the right risks for you. Then you want to maximize those so that you ultimately maximize the growth that you get on your money. Last week, I was looking at a piece on tech shares getting smashed. And I think this is particularly interesting because off the back of and not without its pain points, of course, but off the back of the inflationary data that we're seeing, that with this share market has been on a wild ride, but tech has been hit particularly hard. Now, some people are talking about the fact that tech valuations might have been a little bit overblown coming into the back end of 2021, coming out of COVID. But no matter what I suppose, the ultimate driver of this, we are seeing some pretty serious losses. And I'm unfortunately talking to a number of people that have had some pretty huge amounts of wealth on paper that have really almost evaporated quite quickly, meaning that they're really not in the position that they thought that they were. So what it means for your money, obviously investments are down at this point with the tech market being down. For tech workers in particular, with employer share plans, again, that on paper money, you're seeing a significant decline with that. But for all investors, tech companies and the big global companies, these are the biggest global investments out there. You think if you're Apple, Google, Microsoft, Amazon, Facebook, like these are giants in the market. So anyone that's got a diversified investment portfolio that has access to international shares is going to have a huge exposure to tech, and they're going to be riding the wave with tech over the next little bit. The frustration is, excuse me, the lack of predictability and it's never good seeing your investments go backwards. But the opportunity is that everything is now on sale. All of these companies that were good companies before and they're good companies now, they're now trading for much lower prices than what we're seeing in the recent past, which means that there's a big opportunity there for investors, the right investors with the right strategy to take advantage and make a bunch of money. The actions here, though, to do this and do it in a smart way is to understand your risks and make sure that your investment game plan is rock solid. Then put yourself in a position to take good action. Everything is moving quite quickly here. So I'd say that, you don't want to wait too long. You potentially miss the opportunity there. One other interesting thing that I've been looking at in the last week has been the big banks in Australia. They're talking about the fact that they're set to pay even higher dividends. And what is driving this is, and what's actually going on is that the increases to interest rates actually fatten the bank's profit margins, and they're tipped to enter what some people are calling a Goldilocks period for investors, where they're making more money doing the same business. Obviously, there's been a lot of activity in the property market in Australia as well, which is driving some potential opportunity. And it means that more profit is available to distribute to investors. The banks pay those nice frank dividends as well, so nice and tax effective for their investors too. The frustration, though, I think with this one is that if you don't understand the markets, it can all seem like noise that's really, really hard to make sense of. The other thing is that sectors that do, like last year, we're looking at tech was massively in favor and people were shying away from the more traditional investments like banking and finance. But it's like good fashion that it comes back around as well. So trying to figure out when is the right time to be moving between these is really hard and stressful, and potentially can be costly if you're not getting it right as well. But the opportunity is that for investors, you can make a bunch of money by investing smart. I'm a big fan of investing in the market, passive index type funds. They track the market overall. What that gives you is that for investors, you don't have to worry about which sectors are going to perform best in any given year, because you've always got access to the sectors that perform well. And when companies, how an index works is that the market index is relative to the size of the company. So if a company starts small but then starts performing really well, it ends up increasing in size within your portfolio. It means that you're getting all of the exposure and all of the good juice of the market, but without having to stress yourself out and trying to figure out the time and potentially getting it wrong, making mistakes and costing you money. So the actions here is that you got to know that the market is the market and opportunities are coming around all the time. What you don't want to do is let headlines or fear or greed push you just into the false thinking that you're an expert that can just pick the ideal times and get in and out and make a bunch of money in the process. When you recognize that, you can make more sensible investment decisions that are going to end up giving you better results. One opportunity that I'm seeing for investors out there as well is around cryptocurrency investments becoming more accessible. I was reading about 2 new crypto ETFs which are coming out to launch on the ASX rival stock market index, basically the competitor of the Australian Stock Exchange, CBOE, that they're tracking the price. One's tracking the price of Bitcoin, the other's tracking the price of Ether, which means that you can get access to crypto and the crypto space with a much easier and with some regulatory protection. What the frustration is that it avoids the difficulty of trying to figure out how to access crypto and some of the risks that come with different platforms and trading and security. And we've all seen those nightmare stories about people that have lost money as a result of them working off unsafe platforms or getting hacked or having issues around that as well. The opportunity is getting access to this sector, which has increased by like 133,000% over the last decade or so. and potentially making some money in the process. Tread carefully though, because crypto is not for everybody, and even for investors, it's, you want to be strategic in terms of how it's actually fitting into your portfolio so you can sleep at night. But to take action here, it's about understanding if and where crypto fits for you, the risks that come with this, the risk that comes with these new ETFs, as well as the risks of crypto more generally, and make sure that your plan is solid before you jump in. Now, I've also been seeing a bunch of property news, obviously with the interest rates, inflation rates, and all of this stuff in their headlines. And I thought it was interesting to unpack. One of the points talks to a real frustration that I'm seeing from people around the potential economic headwinds that are creating a lot of uncertainty. And there are 4 key things that are happening in the next 4 weeks, basically in the next month before the federal election. Inflation data coming through. We just saw that release last week, 5.1% record highs there. Rising interest rates, wage growth, and the unemployment. These are all going to have a really big impact on the economy, the property market, and the share market, which means that for investors, it's really like on the wire. This matters because if the outcomes are good of this data, if this reporting, then that's going to be good for you. But if they're not, then it's potentially a problem. The frustration is that the uncertainty puts doubt in the mind of investors and not sure what to do. But the opportunity is that if you're smart about how you plan, you can capitalize on this uncertainty. And it's really the downturns that make millionaires there. What you want to be doing is understanding your options and the risk and how you can manage them, and then taking action. Something else when it comes to property that you should be across is the variance between house prices and apartment price growth over the last little bit. I was looking at some really interesting stats around, we're seeing suburbs in Sydney like North Ryde that have gone up 29% in the year ended the 31st of March for houses, but the apartment prices only grew by 60% in the same time. Homebush 29% versus 7% for apartments. In Pennant Hills, houses went up 24%. Unit prices were flat. And in Melbourne, the story is very much the same. We saw Essendon North was up 19% for houses, while apartments fell by 1%. Canterbury increased for houses of 14%, while units dipped by 4%. Hawthorn East houses up 9.6%, but it was a 6% fall in unit prices. So what that means is that if you're a property owner, this has a huge impact on your equity value. If you want to buy property on the flip side, it's really going to be a big driver of your strategy. What is it that you're trying to do? Which one makes the most sense for you? The frustration, I think, for buyers is the lack of affordability for properties, but for apartment owners, it's really the lack of growth. What the opportunity is, though, I think, is that on both sides, that there's an opportunity with apartments that are potentially undervalued, meaning that it's easier to get into the market. There's been slower growth. You can, potentially take advantage there. For houses, this sort of talks to the real supply and demand issues that we're seeing these forecasts of the property market dipping. But for areas and property types that have limited supply, the price values are very, very well supported. So it means that you've got an opportunity to grow your wealth there. The actions are plan smart, and particularly for first home buyers, you want to be ready to take action, to have a solid plan in place so that you can move when the time is right for you. Another interesting opportunity, I think, for investors is around the talk on fixing interest rates and whether now is the perfect opportunity to fix your mortgage. This, is driven by the fact that interest rates are on the way up. It's almost certain, seeming highly likely that it's going to happen at the next RBA meeting, if not shortly after, and potentially significantly higher as well. There was just had a family member who was talking to about property in New Zealand. They're seeing mortgage interest rates of like 5.5% for variable rates at the moment, and fixed rates are even higher, which is pretty staggering and potentially an impact here. What that means for your money is that the higher interest rates are going to drive up your mortgage costs and slow down property growth, but it will also likely, the higher interest rates will slow down economic growth in your share market. But there's an opportunity there if you're smart about variable and fixed in your splits, that you can make it easy to achieve what you want to achieve with property without costing you as much and in a smoother way. Opportunity is fixed rates, and beating the banks is really, really tricky. But fixed rates do give you a lot of certainty. Variable rates are significantly cheaper at the moment as well. And fixed rates have risen a lot based on anticipation of the interest rate rises that are coming very soon. So what it means, and in terms of taking action here, you need to be really smart. Do you look at the fixed rates and the variable rates and how they stack up? But what does it mean for your money? Can you sustain higher interest rates? Can you afford to lock in? If you pay a slightly higher price now, how much does it cost when you get, how long is it going to take you to repay that money over time? And what does that actually mean? And then you make an objective assessment, because it's easy to get caught in the emotion and think, oh yeah, I want this, or this feels better, or this feels more comfortable. But the reality is it should be driven by the numbers. My final news story for this week is one area that I'm seeing smart investors doing well in at the moment is where the premium suburbs are now coming back into reach for first home buyers. And this is driven by the fact that the price cap for the first home loan deposit scheme is increasing from the 1st of July. So I've been talking to a bunch of people that have been really smart and strategic about what sorts of properties they can access and where, so that they can access this scheme, which means that you can have a lower deposit, avoid lenders' mortgage insurance. And like in Sydney, the price cap is increasing from 800 to 900,000, which is a really significant increase. It means that you can get more affordably into the property market in these areas. And it also means that it's going to have an impact on market activity. And I think you really need to be careful with the false economies that can be created by some of these incentive schemes that people got a few more bucks to play with can have an upward impact on property prices. But look, it gets through the frustration that saving a property deposit is really tough going. Many suburbs are still quite hard to get into. And the opportunity is that with flat apartment growth that we've been seeing in the increase in caps, it's more people can get into the market. As long as you're smart. And the actions here, understand if this is right for you. It's certainly not something that's right for everybody, but if you're going to go down this path, you want to plan smart. If you're thinking about getting into the market and you think you might be able to access, understand if now is the very right time, or if you should be waiting till after the 1st of July, if it's going to make things easier. It means that you can keep more of your cash savings of your emergency fund, which can be quite helpful as well. And beware of those false economies that can cost you. Guys, I hope you found that helpful. I will catch you next time.